Hello, everyone. This is JJ Richa with Bismil Ventures. First, I want to thank you all for coming today to our inaugural broadcast live stream. This is our first time, so there may be glitches. So please excuse us. I got with me David Friedman, the current president of TCA Angels, and also Hicham Semaan, who's the past president of TCA Angels, who just finished his term in early April or late March. Before we get started, I thought maybe we'll do a little bit of housekeeping. One is, so this is going to be about an hour broadcast. After the introduction, we will have about 30 minutes of open discussion. We will then be followed by an open Q&A session. We encourage you to submit your questions throughout the program using the YouTube chat box. So if you're able to, if you can't find it, maybe you could try to find it right now so you're able to send questions. Please don't wait till the end, as we will be potentially answering questions throughout the entire program. We will do our best to answer all the questions, but if you have additional questions that we cannot answer, or please don't hesitate to submit them to pvinfo@bismilventures.com, and then if there are questions that are specific to Hicham or David, I will forward them as well. Please note, this is just you will not notice this, but just as an FYI, there's about 10 seconds delay between the broadcast that we have and what you see on YouTube. All right, to get started, I just want to explain that the purpose of Bismil Ventures live stream is to help startups, entrepreneurs, and the ecosystem understand and navigate our vibrant community by bringing on board thought leaders, investors, serial entrepreneurs, movers and shakers who can add value to our listeners by providing pertinent information about current climate, investment news, what it takes to be investable, what it takes to build, grow, sell a business, and potentially everything in between. So I wanted to just quickly just explain what Bismil Ventures is all about. So what Bismil Ventures is, I'm going to display that on the screen very quickly. So Bismil Ventures, we're kind of a unique combination of a venture firm and a venture accelerator, a virtual accelerator, and a venture studio with a software development arm. So we help businesses with their building their business. We help them with investment resources. We invest in the businesses as well. We help with developing software. We also help them facilitate funding throughout our network. We open doors to make them successful. We are building a fund this year to also potentially invest directly in portfolio companies. And we are a value-based, a hybrid cash and equity, a startup-friendly model. We engage only in a month-to-month basis, no long-term contracts, and we are truly a business partner and investor for the startups. We're going to get started with our program, and first I wanted to introduce our guests. So I have David Friedman. David, he's really casual today, I can tell. And Hicham, it looks cold. Are you cold, Hicham?
It's probably in a summer home in Alaska, you know.
All right, before I have David introduce himself quickly, I just want to say that please click subscribe on the YouTube channel there, so you're always abreast of the upcoming events that we have and interviews. And also don't forget to follow us on social media as well. All right, David, please give us a short introduction, and when you're done, Hicham, please do the same before we get started.
Yeah, thank you, JJ. First of all, thank you very much for setting this up. I think it's the mission you have to navigate and make sure everyone understands the ecosystem, what it takes to be both an entrepreneur and an accredited investor in these kinds of markets is great. I think people will get a lot out of it. My background as a tech executive, I come out of larger companies like Ameritech early on, Bell Labs. Then I went to seemingly the smaller companies, did a couple of startups. Unfortunately, they were not successful, but you'll learn a lot. I've been a member of TCA for about 11 years. And, it's been fun. I've invested primarily through the funds that we've had, the fund that Dave Burkus ran, the ACE funds, as well as San Diego and Orange County funds. And then I do a few sidecar investments as well.
Thank you, David. Hicham?
Sure. I've got a little bit of a different upbringing. After graduating from college, I got a sales job at a computer training company, and was fortunate enough to lead the company in sales for a few years, then moved into sales management, then director of sales and marketing, then eventually led a management buyout of the business, led the business through some growth years, did some acquisitions, sold it to a public company, was with the public company as an executive for a couple of years, and then retired, or at least retired from the corporate world, and moved into kind of private investing, private equity, angel investing, real estate investing, and advising and consulting.
All right, that's very good. So Hicham, I'm going to start with you, as you had just finished your term. A lot of things have changed at TCA Angels since you took over as president 2 years ago. Can you tell us what was your mission as president, and the changes that you've made to really help entrepreneurs potentially get investments faster? Sure,
happy to do that. So when I joined TCA Angels in early 2015, I found a lot of value in the network of like-minded investors. I also found it very engaging to learn about what the startups are doing, what the entrepreneurs are doing. But I also found that there was a lot of inefficiencies in the whole process. It seemed as though entrepreneurs weren't clear on what the next steps were, how long due diligence would take, what the amount is that they would raise, and from the investor side, also similar confusion around, what's the best way to diligence a company, how do we get access to the best entrepreneurs and startups, and how do we make sure we protect our investment. So we pulled together a group of volunteers from TCA Angels. JJ, thank you for being one of those volunteers, in walking through kind of a strategic planning process to identify the key objectives that would really excel the brand of TCA Angels and help excel and accelerate the ecosystem. We ended up with 4 strategic objectives out of that process. One was to improve the quality of the deal flow that our members get to see. 2 was to improve our diligence process, essentially our post-screening process. And 3 was to engage deeper with our portfolio companies that we invest in to add value. And ultimately, we found the 4th strategic objective would be something that would pull all those together, and that is to create a chapter fund where, instead of all of us angels are investing separately in one-off companies, pool our capital into a fund that can simplify the funding process for entrepreneurs, diversify the investments for us investors, and ultimately make us a much more attractive place to raise funds and make us more efficient and collaborative together as a team to help identify, track, and support the best investments.
Okay, all right, and I know you've made a lot of progress, and I have to also say, at the time, David was the VP, so David was involved with everything related to that. So thank you both for all the effort that you've done and to make really this process of funding companies much easier. David, in general, can you tell us what is the mission of TCAs Angels?
Yeah, so when we started the strategy program a few years ago, and that strategy still is relevant today, the mission was to become the best place for entrepreneurs to get seed capital for the ventures. I mean, we are focused mainly in in Southern California, but that doesn't limit us to deals only in California. We've looked at deals across the United States. So to be the best place for seed capital, startup capital. The second aspect goes to the accredited investors that are part of TCA, and we want to be the best place for accredited investors who invest in these alternatives to find the best return on their capital. So the strategy was set up to focus on that mission, and that continues today.
Okay, that was my next question. Is there any change? So I guess there's no change, even with the leadership, there's no change in the mission.
I think, oh, go ahead. You want to start? Go ahead.
No, I was going to ask Hicham just to mix it up a little bit. So Hicham, as far as the mix of investors in TCA, you and I have been around for a while, as long with David. But what is the mix of investors, and is there really a difference between the different chapters that we have, the 5 chapters that we have across Southern California?
Yeah, I think I'll start with the latter. There's a difference in the mix of investors at the chapters, usually representative of the local marketplace and economy. So as you find in different regions, there's industries that tend to excel, like entertainment in LA, medical devices in San Diego. So you'll tend to see a higher percentage of those type of members in those chapters. But in general, I think membership consists of maybe 3 main buckets. CEOs or business owners that have some time on their hands. There might be kind of scaling back their involvement in the business and want a space where they've got peers that they can invest with and look for opportunities and learn. There's the retired ex-corporate professionals or owners that don't want to completely retire and don't want to be disengaged from the ecosystem. And then there's the kind of in-betweeners, the ones that may have left a job, but before jumping into something else, want to kind of see what's going on in the world of startups, want to make some investments, want to support the ecosystem, and try to find like-minded people to support.
Yes. David, I know you can augment this by me asking you this question. So as TCA members, or as investors in general in this ecosystem, I know that we do everything that we can to help entrepreneurs, and we are a volunteer organization. Can you talk a little bit about that?
Yeah, before I do that, I want to just go back to the strategy question for 1 second, because okay. I think it's important. What we started a couple of years ago under Hicham's leadership, I think it's great. We are moving along that. We wanted to formalize a couple of other things that were moving in the right direction, but didn't get totally implemented. So one of the things we wanted to do, as Hicham pointed out, was get better deal flow. Right now, we're building good bridges and better relationships on a more formal basis with other angel groups, with accelerators, with incubators. We have formalized relationships with the Cove Fund, with Octane, with Expert Dojo, and we'll expand that. I think that's important to understand. And that's under Volker Huther's leadership. The other thing we wanted to do is build our TCA brand, because that's the way we can get new accredited investors to come in, as well as the entrepreneurs who understand what we're about. And under Ilko Niermeyer, we're putting together an education and innovation and events program to do that. We'll be working with people like Executive Next Practices, and hopefully with the Orange County Business Journal. So with that in mind, what was the actual question you asked?
Well, you answered my next question, but that's good. My next question was gonna be to you. What is still there that needs to be done? So you kind of answered that.
Yeah.
My question was about the composition of TCAs angels and investors in general. We are as investors, we are as members of TCA. We try everything to do in order to help startups with whatever their need to make them successful. So I wanted to, and we are a volunteer organization at the same time. So I wanted you to kind of expand on that, because that's kind of part of our mission, right?
Yeah, so the fact that we're volunteer is I think really strong. It's a really good news scenario, because we're in it because we have a love of helping people out. We have a love of building the entrepreneurial ecosystem. It's not something we have to do. It's something we want to do. It's part of our own composition. Each one of us. Look at yourself and what you're doing with Pismo. Look at Hicham under what he did with TCA over the last several years. And I intend to continue that. Now, we have programs, for example, like Face to Face with Entrepreneurs. That's normally run by Ray Chan, where we get where entrepreneurs can come in and talk to the investors who show up, and be able to ask questions to understand what investing is about, understand where to get capital for investment. We then break out into sessions that would be more appealing to the individuals. We have also this marketing angels group. So once we have a portfolio company engaged, then we want to help them be successful. We pull together people not only within TCA, but also from the UCI and other service provider communities to take a look at business plans, marketing plans, sales plans, and try to help them focus their energies on things that would be the best for them to grow. Because one of the things we don't want to do is just give capital. We're smart money in a sense. And it goes back to what Hicham was saying. We have a variety of different people, from CEOs, people who start companies, people who looking for the next job. We have a lot of smarts of the 475 people. We can always find somebody to help an entrepreneur be more successful. But in addition to that, because of this breadth of talent we have, we keep each other on our toes, and it's a learning organization. We want to learn more. We want to do more with the organization so we can be more effective investors. We can contribute more to the entrepreneurial ecosystem. And so that's, I think why being all volunteers makes sense to us. It's a passion.
Yep. Hicham, a question about, I don't think we could get away from asking this question. So a question about, given the current climate, the environment, the COVID-19, the pandemic, and the portfolio of many investors being affected, do you see funding being declined from the investment community?
Yeah, I think it's going to be a double-edged sword. So I think on one end, the existing businesses that are running low on funds, that haven't hit certain milestones to really show a lot of momentum and value creation, it'll be challenging to raise additional funds, because most investors out there were probably in the stock market, or probably feel a little uncertain about the times, and might be a little bit tighter with funds. On the other hand, I think the opportunity in this kind of landscape is empowering for people who, you've got a lot of people that lost their jobs, and they're looking for new opportunities, and that's really when a lot of them empower their friends, their teams, to build something new. And so you'll get some great talent that wasn't available, that wasn't considering making the jump into a startup. You'll find a lot of people start now, as opposed to jumping into a new job somewhere else. And so we'll find a lot of opportunities. There might be less overall capital, but I think there'll be new, great, exciting opportunities that will warrant jumping off the sideline and investing in.
Okay, all right. So, David, this is kind of following on to the question for Hicham. Are we going to, or investors in general, are they going to look at companies in a different light?
Wow. The answer is yes and no. Let's take two different kinds of entrepreneurs. Number one, where they're coming into TCA or another angel group for the first time. I think we're going to have to really think about what's important to them. We have certain questions we ask. We'll go through our due diligence, but to break it down into very simple ABCs, we want to assess the market segment. We want to make sure the market is growing. It's the right market to have a right product market fit. Number B, we want to make sure we understand the business model. This isn't one where just throwing money at people, praying and spraying and praying, works. I mean, we want to find a business model that works. And I think particularly in these times, we want to look at conservative management, conservative, not, in terms of financials. We don't want to see people just spending, a rash of money just needlessly because they were all of a sudden able to get funding. That's for the entrepreneurs coming in. The second aspect are the companies that are in our portfolio, and now we have to look at them. And we have to look at them in a little different way. We want to be able to protect our investment, but we also don't want to provide money after bad money. So in a sense, we have to make sure as we coach them and we're available, goes back to your question on, the volunteers. We'll try to help those companies even in any times, but particularly in these dire times when, people have become employed and, money is becoming scarce and, sales are not as prolific as they were. So we'll have to relook at their business model, look at their financial management, because we do want them to survive. If we don't see those existing companies as they come to us for new capital as being worthy in terms of the business model, conservative management, and the market, then unfortunately, we are just not going to invest in them anymore.
Okay, all right. Thank you. I just want to remind everybody to post your questions in the YouTube chat box. We're going to take a first question. Hicham, maybe you could take this one. It's right on the screen.
What about a startup that began with no money from years of unemployment? What about a startup?
I know that's a tricky, interesting question.
Years of unemployment.
So it started potentially out of necessity or out of not able to find a job, maybe.
Yeah, I'm not sure what the question is, though. What about a startup that began? So is the question around fundability?
Either fundability. Yeah, maybe let's answer it from a fundability standpoint.
Sure. I think from a fundability perspective, it doesn't matter whether it's been years at working at a startup, or whether you just started it up, or whether it's because you were unemployed, or whether you are currently employed and doing it on the side. I think it's really around what milestone are you at, what momentum and investments have you put into the business, and what do you need the funding for? I think that last question is one of the most important questions. Do you need funding to accelerate the growth of the business and you've got a proven model? That's what most investors are more interested in investing, and those are typically less risky. If you're looking to raise funds to flush out the idea and to build the business, it's a higher risk investment. It's not for all investors, and it would also warrant a much lower valuation.
Okay, that makes sense. Any comments, David, on that?
Yeah, hit the nail on the head.
All right, perfect. So, David, kind of back to you. What are the areas that you see future investing will be? I mean, you think there's going to be like a specific COVID-19 or pandemic type of specific investments? Any special funds that would just invest in companies that could solve these big, huge problems?
Yeah, so I was frothing at the mouth, wanting to hear you ask something like that. I mean, it reminds me of Wayne Gretzky saying, "I skate to where the puck is going, not to where the puck has been." And I think it's very important because angel investing is not we're not day trading. We're looking at something that can be mature and something that can have a liquidation event in 4 to 6, 7 years. So we want to find where those opportunities are. Go back to COVID-19. Now, we do see an increase in the number of deals coming to us, entrepreneurs, with things relating to diagnostic, to testing, and to things relating to different therapeutics. Some people have actually pivoted in looking at what they were doing in one area. For example, we had a company come in last week that was doing cancer research, but they can take their assay program and they can take their diagnostic program and move it into COVID-19. We also are looking at the repurposing of certain drugs with adding additional combinations, as you see what Gilead is doing with their drug that was used for Ebola. We're seeing the same thing in these markets. We're also seeing Richa at UCI pulling together people from Octane and TCA. Remember, we have a medical screening program under Thomas Lee, so we are actually looking at these things anyway. But he pulled together a variety of different deals that we were looking at collectively yesterday to push ahead and to fund those companies. That's the COVID-19. But besides that, we believe in a variety, at least I believe in a variety of different opportunities. Number one, we're looking at things relating to AI and big data. Data and content is prolific. It's growing almost exponentially now. We need to figure out the better way to take a look at the data, to analyze the data. We have to look at things relating to precision medicine. This is something that was started by Chalk and other medical practitioners. We want to see how we can take a look at the disease and figure out the way to use the data and what we see in trials to figure out the best medical approach. We see implantables. We're seeing more med tech devices, and we know we're a med tech haven in Orange County. We're seeing more devices that combine with the iPhone. We're seeing, for example, a public company called Zeo. Zeo Patch is the name of their business. We're seeing things like that. We put a transponder on your body, you record events, and you have them on your iPhone or iPad. Because of COVID-19, we're seeing more on automation, couple automation with AI and big data. And now you see where that is going to be an area, for the future. And we're also seeing things relating to green sustainability, because that's what happened before. It has not come to fruition yet. Those are some of the areas that we're looking at. Oh, forgot cybersecurity, because we're all working from home. We're afraid of getting, somebody hacking into our webinar, and taking it over. We like you. We don't want some other host replacing you, unnecessarily. So cybersecurity is going to be a big issue going forward. We're seeing some cyber programs come into play.
And to add to that, a lot of companies are actually pivoting to really, get into the COVID-19 pandemic type solutions, because they have similar solutions that apply to other industries or other potential areas. Hicham, I'm going to go back to you and go to some basics. We have some questions that are popping on the screen, but I want to go to a basic question that I run into all the time. Maybe you can help explain that to the entrepreneurs that are listening to us. I hear sometimes, hey, look, I'll give you 10%, dividend for the next 3 years, and why don't you invest $1 million in our company? So can you explain from an investor perspective, what is an investable company and why dividends is not what we're looking for, and what it takes to really invest into a startup that at least angel investors or professional investors or VCs are looking to invest in?
Yeah, that's a great question, JJ. I can answer it from my personal perspective, and that's important because every investor, especially angel, perspective on what they need to get comfortable to invest. So I look for the 3 T's the team, an experienced team that's done it before in the industry, in the specific product or service, and has preferably built a company and sold it. That's the ideal type team. So T, team. T, timing. Is this the right timing for this solution? So is the marketplace in an upswing for this type of a solution? Is this a growing industry? Is the tailwinds or headwinds in place where it would make it either more attractive or less attractive? And then the last T is the terms. Are they making it attractive for me to get a return? If the 3 T's are there, I'll typically invest. If the 3 T's are not there, then it's got to be a strong 2 of the T's have got to be there for me to get comfortable. If you've only got 1 of the T's, it's unlikely that I would be personally interested.
All right, that's good. So when it comes to, just to answer the dividends questions versus an exit question, can you expand on that a little bit?
Again, I think that's a personal preference for an investor.
Okay.
For me personally, I look for an exit as opposed to a dividend cash flow investment. The startups typically can't pay enough of a dividend or royalty stream or cash flow stream to make it really appealing. I'm hoping for the 3, 5, 7 year big potential exit to make it worthwhile.
Okay, David, I'm assuming that most, I know that Hicham said it is a investor prerogative or preference, but most investors in general prefer what Hicham just said. Is that correct?
Sure. I mean, we would like to get an exit. I mean, you know, the probability of a startup becoming, or you know, a viable long-term mature company is relatively small. When we look at 100 companies, we may find of that 100 companies, 80 will, at least 80 will disappear. They will not make it beyond a few years. So the risk is very high. So as we were talking about de-risking the investment, and when you de-risk the investment, you're looking at the team. Can they pivot? Can they manage it conservatively? Will they run out of cash, which is a big issue with many of these, you know, companies? So the answer is yeah.
Okay. So I'm just toggling back and forth with Hicham and David. So the next question is from Elizabeth. I'll display it on the screen. Hicham, let me know if you can take that on.
Hey, Elizabeth, how are you?
So go ahead, read it.
Investment in particular industries, or is it industry agnostic? What role might attracting a diverse deal flow play in your future planning? So I'll answer it very quickly from my perspective, but that's probably a better question for David since we're looking forward. But TCA is industry agnostic. We tend to invest in companies we understand, which means hopefully we have members that understand or experienced in that industry. If you can find TCA members that understand your business and start the dialogue early with them, I think that helps a lot. But it doesn't matter. We've invested in farming companies. We've invested in cybersecurity and med devices. If the team is there, the timing's there, and the terms are there, we'll consider investing. David?
Yeah, I mean, we're pretty much agnostic. I mean, we want to find the ones that have the highest returns. Clearly, when we look at multiple software companies, IoT companies today, bio, pharma, med tech, although those have a longer time horizon. So, you know, those are the areas we tend to focus on. And it goes back to the geographies that we're in, you know, in LA, media, entertainment, gaming. Here, software, cyber, and med tech, and down in LA, we're talking wireless, and I'm in San Diego, talking about wireless, and we're talking about life sciences. So those are the areas. We don't do as well in consumer products, for example, although we have invested in some.
Yeah, we've done a few of that. Hicham, this is a question for you on the screen.
Is it worth it for a pre-revenue startup like mine to get a third-party valuation? Is there any benefit? Maybe some benefit, but not a lot. So I would caution you on spending that money. I personally don't put a lot of weight in third-party valuations because they're hypotheticals. It typically doesn't incorporate the startup team. What it typically does is look at kind of public company industry averages or some kind of standards that are applied. What might be valuable is like an IP valuation or valuation of certain products or value features of the company that are fairly standard in the marketplace, or that there's a credible way to value. Other than that, if you're simply trying to pay for a third-party valuation to justify your valuation to your investors, I haven't seen that help. At the end of the day, you've got to motivate investors to be excited about your company, about you as a team, and about the terms. And I think you're better off spending that time and money working with the investors you're pursuing to understand what they're interested in, what they liked and didn't like about the business, and how to overcome those.
So I'll add to that, especially at the pre, when you're not making money yet, and maybe David is referring to maybe a 409A valuation. That's potentially a lot of money that you could use to really make sure that your business, you can prove your business, it does what it does. And maybe as Don Castle says all the time, I hope he's on, he says, will the dog eat the dog food? So try to spend that money on making sure you have a good product market fit instead of a valuation. Next, for you, David, this is specifically to the COVID-19 question we had before.
Yeah, from TCA's point of view, how has the cost of capital changed due to the COVID-19 environment? I would assume what you're really referring to is, are we seeing valuations change, due to it? We have, and the other component is capital available. So the answer is capital is available directly, even with a reduction in some of our portfolios, although today it feels a lot better than it did on March 20th. So most of us are more willing to invest. I mean, the market has been going up and we feel like we can see a light at the end of the tunnel. As far as valuations, what we had seen in the past are valuations getting a little into the stratosphere. I think people realize that right now it's a little tight, money may be a little tighter, it's a supply and demand. We have seen some valuations come down. One company that presented to us was at 6 million before the COVID-19 crisis. They came in with 5 million. See, the issue really is interesting. Early on, it doesn't make a difference if it's 5 million or 4 million, although to Hicham's point, we have to look at it from a return perspective. But from an entrepreneur point of view, you want the capital for growth. And we're seeing, I think, a little more reasonable valuations. But I also want to say that if your valuation is high, we'll let you know, we'll give you the reasons why it's high, and we will suggest options. And we've also seen companies that have come in with the valuations low, and we say, hey, this doesn't make sense, raise the valuation. We don't want to really take advantage. We want it being fair on the entrepreneurial side, and we want it fair on the accredited investor side.
All right, very good. This is a question from John. I'll just take it quickly. Yeah, John, it doesn't really matter. IT security, a medical device, a TCA is agnostic from that standpoint, so it really does not matter. This is a multi-question from Walter. So what are the basic benchmarks you look for in regards to making an investment? A return on investment, average minimum investment, industry, management team, sales company. So sales company. So I know Hicham answered that to some extent, so I'm going to let David take that one on for now.
Yeah, I was going to say this is like a toss-up question. I'll take, can you put the question back up? I'll take management team for 500. I think when we have a way we look at the investments and we classify, and this is not only true of us, but the other angel groups. Number one, without a question, management team. Did they work together? Can they execute? We have to have that confidence that they'll be conservative and they won't be too loose with our money. Number two, we'll look at the sales of a company is not really critical. It's too early on. Core industries, certainly we see a higher return on software, med tech, some entertainment, some life sciences. We've been fairly well poised in those markets for over 21 years now, and we have a track record of seeing where those returns, and we have a history of seeing those returns. Return on the investment, that's an outcome we hope to get. Again, if you look at 100 companies, we're really betting on the top 5 of those 100 companies or the top 10 of those 100 companies, giving us the high 10x, what you call the 10x returns, 10 baggers, that will help us make up for a lot of unfortunate losses, in the other businesses that don't make it. Hope that answers the question in a kind of a semi-humorous way and a very truthful way.
All right, that's good. So we have a question. Hicham, you can take that on. This is basically, what are current requirements to be an angel?
Well, when I was president, you just had to have a pulse, but I think David is
I don't think so.
Year than I am. I think David requires you to be an accredited investor.
David.
And
the SEC rule.
Yeah, and there's public information out there on what it means to be an accredited investor. You've got to either make so much per year or have a net worth of so much, excluding your personal residence. So that's really all it takes to be qualified to be an angel investor. And for TCA, we've got an application process and a membership committee that will vet you as a potential member. So Kent, if you're interested in Tech Coast Angels, you could reach out to me, you can reach out to David, you can reach out to JJ, or you can go to our website and apply, and we'll walk you through that process.
Yeah, can I add one other thing to what you said? So we have different categories of angel investors. We just started a new category. It's called virtual membership. Virtual membership are for those accredited investors that can't attend our meetings. The good news is we started a few years ago using WebEx, and now we use Zoom and WebEx and GoToMeeting. So even if you're an accredited investor and can't attend the meetings, you certainly can participate remotely and have access to all the deals. And I think that's a very good deal for a lot of people, and that's why our membership has shot up a lot.
Kent followed up with another comment saying TCA used to require a minimum dollar amount per year. He's referring to investments. So yes, there is a requirement for that. And also right now, since we started the fund, I think potentially being part of the fund is going to be a requirement as well. So please reach out to us individually, and we will put you in touch with the chair of our membership, and he'll explain to you all the details. We'd be happy to do that. We have another question on the screen, so I'm going to display that. If a startup is heading towards its seed funding runway, would you recommend a bridge or a Series A construct if the product is just beginning to gain traction? David, you can start, and Hicham, maybe you can add to that.
Well, hopefully you are not at the end of your funding, because it takes a little while to get funding. You don't want to be in dire straits. If you're in dire straits and let's say you're Series A, you want Series A to be maybe $3-5 million. And let's say you need a bridge loan to get you over the hump, and maybe you need a bridge loan of $750,000 to $1 million. It may be easier to get that bridge loan through a convertible note, offer a discount to the angel investor, and therefore you can get them into your, to play on your side. And then it makes it easy, because we do look at successive rounds. So not only would we potentially get the convertible note, the bridge loan, but we'd also be most interested, especially if you're gaining traction in your with revenue, we'd be able to participate in a follow-up round. So it really just depends on your circumstance. Talk to one of us, we can give you some guidance, but it will be up to you and the rest of the team to determine what is the best way to stay fully funded and not come across as desperate.
Okay, Hicham, any comments?
Yeah, I'll try to simplify it. So to me, a bridge loan has a specific use, and it's usually to bridge. So you've got here. Let me swap my hands for the camera. You've got your seed round that is at a valuation that's maybe below where you think you are today, but your A round you expect it to be at this level, but you're probably not able to justify it today. So you want to bridge this gap, right? And so when it's that circumstance, a bridge loan makes a lot of sense where you feel the company's going to be a lot more valuable any day now. You're close to that milestone. You don't want to give away the farm by raising more funds at the seed level. So you'll raise just the minimum amount in a bridge facility that probably has some kind of discount towards the A round or some kind of in-between valuation that helps supports your dilution and provides you kind of the biggest and best upside while maintaining enough runway to get to the Series A funding.
All right, that's very, very good. Thank you so much. I have a question from David McConnell. You guys probably know him. So David is talking about, can you comment on equity crowdfunding, not Indiegogo crowdfunding versus, or as an alternative approach to angel funding? David?
Yeah, I'm not sure I'm the expert on equity crowdfunding. I know that there are several sites that do exist for equity crowdfunding. The problem when you have equity crowdfunding is unless you're able to get one or two larger investors, you're really talking about a large number of people participating in that investment. And then you have an interesting cap table. You have all these investors coming in with low dollar values you have to be able to manage over a period of time. If you can't, and there are sites, Funder, you can go to Angel Co. You can pick up, equity, or you can put it up on one of the other crowdfunding sites. But if that's the way you have to raise money, I think it's fine. I think you can go alternative routes. You don't have to do one or the other. But instead of going to equity crowdfunding for a company that's really serious, I would try to go to one of the angel groups, go to Keiretsu, look for a high net worth individual versus equity crowdfunding because of the cap table issue. That's just
okay.
my.
Do you have any opinion on that, Hicham?
Yeah, similarly to David, I think there's pros and cons to crowdfunding. The cons, I think David pointed out very well. The pros are that it sometimes validates the interest level of the kind of marketplace, specifically if it's a product. If it's a consumer-based product, then I tend to see that crowdfunding makes more sense and it validates the demand and interest out there. But I definitely agree with David. I'm hesitant to invest in companies that have done crowdfunding because you just don't know who those different partial owners are out there. There's so many of them. And I've been in too many investments where, different investors cause more problems than they add value. So it's just something to keep in mind.
Yeah, can I add one other thing too, JJ, on that? The difference between equity and product crowdfunding, just leave it like that. Equity crowdfunding, you're betting on the company, you're not getting anything in return. One of my first investments at TCA was because I liked the company. They went to crowdfunding. He was able to sell, in a sense, pre-sell his product. It looked great. The market looked great. His demand looked great. And in retrospect, that was the entire demand for the product, and it kind of blew up on us. So you got to be really careful. But crowdfunding works really, really well, like what Hicham said, on a consumer product where you get something in return, because otherwise you're just speculating. It's just like playing the slots. You're throwing money at a percentage of a company. You don't know what you're getting really in return until some future point in time.
Yeah, I'm going to agree with that. I'm going to say also, when it is a consumer product, it makes just a ton of sense to do it. Now, there are a lot of crowdfunding companies out there, but from my perspective, also there are some companies. Again, I'm going to insist on the consumer product type, but there are some companies that they're not going to be able to get angel investors or any type of investment, and crowdfunding could be the right avenue for them. So it shouldn't be discounted. There is a group down here in I think Laguna Hills. It's called Title III funds, and they're helping startup companies with crowdfunding as well. So so David McConnell said he agrees with the convoluted cap table. Question for either one of you, because I am not really at all familiar with this. I'm familiar with it, I just don't know enough. What do you guys think about opportunity zone funds that allows investors to defer some capital gains? Anybody that knows this?
Yeah, I actually live on the fringe of one in San Juan Capistrano, but the real expert on this, and you may want to put him on the show, is Gerard Miller. He has looked into opportunity zones where you actually get an advantage because the government pays you or has certain incentives for you to set up your business there. But that's the only point I wanted to raise. It may be something for a future, a different way to look at some of the entrepreneurial issues, and that may be one of them.
Yeah,
okay.
So I've invested opportunity zones quite a bit, mainly because of my real estate investments. I think the benefits of opportunity zones and opportunity zone funds are tremendous. The challenges are that there's a lot of requirements that have to be met, both where the capital came from, what the capital is used for, how long you hold it. And so I think if your project or opportunity meets the different requirements, then it's great, it's awesome. I wouldn't try to force something into an opportunity zone fit. So Walter, if your question, what do I think of opportunity zone funds? I think if you're looking at it as an investment opportunity in an opportunity zone fund, I would want to look at it just to see, is this something that they know well, or are they trying to capitalize on the opportunity zone tax benefits? If you're finding that they're trying to capitalize on the tax benefits and it wasn't a strategic direction or industry or structure of the company previous, then I'd be concerned. If this was the focus of the company and strategy and it just happens to now fall into the opportunity zone, then I definitely icing on the cake.
Okay, all right. Thank you very much. So I'm gonna just we have a few more questions here, but I'm gonna ask a question from my pile of questions, just to talk a little bit about the fund. So next week, just to let the audience, we have Jim Pickell, who will be on the show. So he'll talk a little bit more about that. But as far as the fund is concerned, is the fund agnostic? Is it looking for specific investments to be made? Does the fund work with other entities like syndications? How is it? Maybe Dave, Hicham can start you on that as well.
What was the specific question around that, JJ?
The question is related to the fund. If the fund is that we just formed, the chapter fund, if it's investing in specific industries, or is it agnostic? And the second question around it is, does the fund syndicate?
Yeah. So as far as what the fund is focused on, think of the fund as an extension of TCA and TCA membership as a whole. So the fund invests in what the TCA members that invested in the fund are interested in. So we have our screenings usually twice a month, and there's a majority of our members that decided to pool their money into this fund. And so if a majority of those members are in support of investing in a deal, then the fund invests. And the fund was really designed for two main purposes. One is so the fundraising company knows that if it sparks enough interest from our members, there is funding already set aside to invest in their company. So they don't have to corral a bunch of investors and have them open up their checkbooks. There's funding already there waiting to be invested. And then two, the benefit of the fund is for investors to diversify. So instead of having to cut separate checks for multiple companies that you're interested in, where most companies have a minimum investment amount of 10 or 25 or $50,000, now the fund can invest the 100 or 200 or $500,000, but your portion of it might be 2,000 or 1,000 or 5,000, and you diversify over 15 companies, where before you might have not had the wherewithal or the interest to invest that much in so many companies.
All right, David, any comments there?
Yeah, the fact that we have two different vehicles for investing. We have one, and first of all, I got to congratulate Hicham. He was driving for this fund for 2 years and was able to pull it off. And it's not insignificant to actually build a fund and get it started with all the different, the costs, the rules, and the people involved, but so kudos. We have two different mechanisms. We have a mechanism called Fast Track. Fast Track allows us to look at other deals that came from syndication partners, other trusted angel groups where they've done due diligence. And in those cases, we can make a decision within 7 to 10 days for $100,000. It becomes very quick. The longer due diligence can take a little longer time, could be up to 30 days. That's a lot more formal because we have nothing to go on in the past. But it's the great thing about the fund, especially now during COVID-19, when you go back to the earlier question, you said, do we have money to invest? And the answer is yes, because we have the fund already capitalized, and we can use those funds in the fund to be able to, put money into companies that we think are worthwhile. And in addition, when that opportunity comes to the fund, it either before it gets to the fund or even after, it allows the individual accredited investor within TCA to invest and co-invest with that fund, so we can actually get the entrepreneur more money. But we get, but it's a very positive thing for the entrepreneurs as well as the investors. Thank
you very much. So while I'm doing some closing comments, the hour is done, so it goes by really fast. So I'm gonna ask you to think of just one advice that you would advise on an entrepreneur or startup. So I'll do some final comments, closing comments, and then I'll come back to you. So just one advice, not a series, just one. All right. So first, so I'm gonna go back and say, please subscribe to the YouTube channel so you're up to date with what we're doing and abreast. You keep to stay abreast of future programs and events. Also follow us on social media. If you do have questions that we did not answer, you can always email them to pvinfo at Bismil Ventures, and I will forward any information to Hicham or David. Future events next week. Again, the interview is a fireside chat with Jim Pickell. He's a TCA Orange County fund manager. I think we're going to change the time to 11 instead of 11:30 next week. I know that this week was at 12:30, just because Hicham couldn't make an earlier time. But moving on, I think we're going to do it at 11 because there's another event that we don't want to interfere with. That's starts at 12. That way, the ecosystem can benefit from both events. Also on Thursday, April 30th, another TCA member, Garrett Brown, with his colleague Colin Coggins, they're going to do a free sales mindset for entrepreneurs webinar, and we will be hosting it. It will be on a different link, but if you did not receive any information on that, please look through to our newsletter that we sent out today and we'll be sending out as well. So coming back to David and Hicham, Hicham, why don't you start? What's your one advice?
Well, first, JJ, let me thank you for putting this on and for inviting me and for your years of help at TCA and in the ecosystem. Thank you. You're making a big impact. My advice, my single advice, is the same advice I give to salespeople, to managers, to my kids, and that is when you need something from someone else, put yourself in their shoes. So I think a lot of times these fundraising CEOs, they're talking about their company, they're talking about the marketplace, they're talking about their terms, and they don't really understand what it is that, pushes the buttons for me. And so understand who you're talking to, put yourself in their shoes, see if you're the right fit for them, or see what it is that they're interested in to maybe modify what it is that you're doing to make it attractive for them.
Very good. David, last word for you.
Wow. That was what I was going to try to start with, Hicham. So I'll have to go on the back end of that, but I think that advice is great. I think it correlates with what you're saying. Tell your story and tell it well. Don't get distracted. Make sure that you understand, and stay on focus. I guess story and focus are related. Make sure you always know where you're going. Display your passion for that story and make sure we understand that story and understand it well.
I agree with that. So I'm going to say focus, focus, focus. A lot of entrepreneurs, they want to do like 20 things at the exact same time. It's hard to do just one. It's hard to launch a company with just one thing. To try to do it, trying to do multiple things at the same time is very, very difficult. David, thank you so much for being part of the program today. I really appreciate your opinion, your advice to the entrepreneurs and to our audience today. Hicham, same thing. Thank you so much for your leadership the past couple of years. It's been really great, and we're looking forward to a great 2 years with you, David.
Thank you, JJ. It's great you to put on these things for everybody. Appreciate it too.
Thank you. Have a great day, everyone. We'll see you in other live events down the road every Monday. Bye-bye.